I'm Bennett Royer, and welcome to the VP of Finance training. Congratulations on getting elected VP of Finance for your company this year. You're going to have an exciting year ahead of you with a lot to learn, and you're going to see what being a VP of Finance is all about. In this training program, we're going to go over the importance of a VP of Finance and why your company needs one so badly. First, let's discuss why it's important for a company to have a VP of Finance and why you should be so excited about your role in the business this year. Throughout the year, your company is going to be bringing in money and spending money, and it's important that they know exactly how much they have and how much they need to spend at any given time. This is called cash flow management, and it's one of your most important roles as a VP of Finance. Cash flow management is the art of making sure that the company is bringing in more cash than they are spending, and that any expenditure is going towards the best use of funds. In other words, the VP of Finance is the company's financial gatekeeper. As the VP of Finance, you want to make sure as much money as possible is coming into the company, and only the money going out is required expenses like rent or materials, or expenses that will produce more income like marketing or trade shows. Now, let's get into the types of financial transactions you're likely to run into in your role as the VP of Finance. Most likely, the first source of cash your company will come across is the sale of shares. Consider people who buy shares as the founding members of your company. They will be entitled a payout at the end of the company program, ideally for more than what they bought their shares for. It is your job as the VP of Finance to make sure the company is worth more at the end than it was at the beginning. So let's say that at the beginning of company program you sold 20 shares for $10 per share. This means that you start your company worth $200. At the end of company program, your goal should be to have more than $200 to distribute to those same shareholders. As a note here, when you earn cash from either the sale of shares or products, you will need to decide how much cash you deposit into the bank account and how much is kept on hand for short-term expenditures. Short-term expenditures could be things like marketing or new materials for product. The next transaction you'll likely run into, now that you've raised money for your company, is a use of cash to purchase materials. Purchasing materials is what allows you to build a product and start selling. It is important as the VP of Finance for you to know how much product your company plans on making and selling so that you do not overspend or underspend on materials. Once you've purchased materials for your company, your employees will start to make product, and you'll be required to pay wages to those making the products. As the VP of Finance, you'll be responsible for helping your company decide on how much to pay in wages. Keep in mind that any wages will reduce your cash amount and decrease the amount available to market or make more products or distribute to shareholders at the end of the year. On the other hand, you need to keep your employees happy. Now that you've paid your employees to make your product and have finished inventory to start selling, you're going to want to market it. You can do this by putting up posters, creating a website, setting up a stand, or any other creative idea your company comes up with. The type of activity will most likely cost you money and is commonly referred to as selling and marketing expense. This will be where you help your company shine. Your responsibility here is to help set a budget for how much your company wants to spend on promoting your product. The key to successful sales and marketing programs is to only spend money on activities that will bring in more sales. You'll also run into costs that don't directly help you make more sales. These are called fixed costs, and they usually consist of rent, bank fees, and fees paid to junior achievement. As a VP of Finance, you need to make sure there is always enough cash in the company to pay for these expenses. Finally, now that you've made your product, marketed it, and paid for all the behind-the-scenes activities, you will start to see sales. This will be the second form of income you see as a VP of Finance after the sale of shares. Ideally, a successful company will be able to fund all of its operating expenses from the cash generated from sales. Let's take a look at how each of these transactions will look in your general ledger. A general ledger is what you will use to keep track of all the transactions that happen in your company. For a VP of Finance, the general ledger is a very important tool and will help you keep track of the cash in your company, the income you've earned, and the expenses you've incurred. Junior Achievement has provided you with a template for entering entries into your general ledger and producing financial statements. It's not required that you use this, but it's a very useful tool. An entry into the general ledger should always be done in two parts, a positive entry and a negative entry, to keep the financial equation balanced. The financial equation is assets is always equal to liabilities plus equity. As an example, in a sale of shares, you will have a positive entry to cash and a negative entry to shares. Simply put, you had 10 shares in your hand, but you sold them for $10. You've added $10 in cash, but lost $10 in shares. You now have $10 in assets, cash, and $10 in equity, shares outstanding. And the financial equation is still balanced. Now, let's assume you put $5 of that cash in the bank and use the other $5 to buy materials. This will take two entries. Firstly, you would make a negative entry to cash and a positive entry to cash in the bank. You had $10 in your hand, but you lost $5 by adding it to the bank, but you've added $5 to your bank account. Now you have $10 in assets, $5 in cash, $5 in cash in the bank, and $10 in equity, shares outstanding. And the financial equation still balances. Secondly, you spend $5 on materials and make a negative entry to cash and a positive entry to inventory. Again, simply put, you had $5 in your hand, you gave away that $5, and in return you got $5 worth of materials. Now you have $10 in assets, the $5 you still have in the bank, plus the $5 of materials or inventory, and $10 in equity, shares outstanding. And the financial equation still balances. Now your employees are hard at work making your product. You owe them a wage, but won't pay until the end of the week. This is called a wage payable. You can also incur payables with materials or any other expense that you do not pay immediately. In this case, you owe your employees $2 and you make a positive entry for wages on the income statement and a negative entry for wages payable on the balance sheet. Your company now has $10 in assets, $5 of cash in the bank and $5 in inventory, $2 in liabilities, your wages payable, and $8 in equity, your $10 of shares outstanding, and negative $2 retained earnings. When you pay them real cash, you will make a positive entry to wages payable and a negative entry in cash to show the actual outflow of cash. Your company now has $8 in assets, the $3 of cash in the bank, and the $5 in inventory, and $8 in equity, the $10 in shares outstanding, and still the negative $2 in retained earnings. And the financial equation is still balanced. Any cash expense that is paid immediately would be recorded as a positive entry to expenses on your income statement, which flows to the retained earnings section of your balance sheet, and a negative entry to cash in the assets section of the balance sheet. For example, now that you've made your product and paid your employees, you spend your remaining $3 to market your product. You would make a positive entry to marketing expense and a negative entry to your cash in the bank. Your company now has $5 in assets, your $5 in inventory, and $5 in equity, your $10 shares outstanding, and now a negative $5 in retained earnings. And the financial equation is still balanced. Now all this hard work finally pays off and you get some sales. And it's a big sale. You get $25 of sales. This would go into the general ledger in two entries. The sale entry would be a positive adjustment to cash and a negative adjustment to sales. The inventory adjustment would be a positive adjustment to cost of sales and a negative adjustment to inventory. In simple terms, you've brought in $25 in cash in exchange for the $5 in inventory that you originally had. Your company now has $25 in assets, cash, and $25 in equity, your $10 of shares outstanding, and $15 of retained earnings, or $25 sales minus $3 in marketing expenses, minus $2 in wage expenses, minus $5 in cost of sales. For more examples on how to enter transactions in your ledger, ask your advisors and company program. Now let's get into what you'll need to contribute to your company's business plan. You'll need to set a sales target for your company. This is important because it will act as a goal for your company to achieve. You can set sales forecasts by deciding a number of products each company member will sell and multiplying by the number of company members and the price of each product. Or you could also base it on a percentage of the products you make. For example, you want to sell 90% of all inventory. There are many ways to set your sales target. The important part is that you set a goal and measure the company's sales against it as the year goes by. You'll also have to report on the amount of wages that your company will pay and how they will be determined. For example, does your company want to pay commission to encourage sales, or will it be a flat dollar per hour wage? As the VP of Finance, it's important to understand what your fixed costs are as well, and whether or not your company has enough funds to pay them throughout the year. In the business plan, you should explain what your fixed costs are and how you plan to pay them. For example, rent is a fixed cost because it does not depend on how many sales your company makes. Perhaps, as the company's VP of Finance, you've decided to set aside a rent account that always has enough money in it to pay the company's rent. This money is not used for anything else. Now your cost of sales and sale price. This will be the amount it costs to get one unit ready for sale and the amount your company will sell it for. Cost of sales will include any materials that go into your company's product. The sale price should consider your cost of sales, other expenses, and fixed costs, and earn a profit for the company. This leads into the next very important measure, the break-even point. The break-even point is very important in determining the amount of units your company will need to sell at a specific price to earn a profit on each sale. In a formula, the break-even point looks like this: total fixed costs divided by the unit price minus the unit variable cost. In simple terms, this formula shows you how many products your company will need to sell to make $0 of profit at your chosen selling price. Fixed costs will include rent, wages, JA fees, and bank fees. Variable costs will include materials. As a VP of Finance, you should be able to do an analysis on different sales prices and explain why you chose the sale price you did for your product. In closing, enjoy your year as the VP of Finance. It's a wonderful opportunity and a very important role in your company. For more information, ask your advisor and company program, or email me at bennett.royer@ca.ey.com.